All right, so it looks like the administration is going to go there, right, folks? Taxing unrealized profits to help fund that spending bill, we're being told, could be ready by Thursday. Yep, people will have to pay taxes on assets that they haven't taken profits on. But don't worry, we're being told it will only apply to 1,000, right? The top 1,000 wealthiest folks in America. There's just one reason, though, that I'm worried. You know, you see, back in 1968, there was an article, I think it was in the Washington Post. It pointed out that 155 American families had paid no federal taxes the year before. As you can imagine, the nation went into an uproar. By 1969, the alternative minimum tax was born. It was created to make sure those families paid their fair share. So their fair share began at $200,000, and that's the problem. Well, by 2004, this tax applied to 5 million people, from 155 to 5 million, because that 200,000 threshold was never adjusted for inflation. Joining me now from the University of Maryland Economist Peter Morici. Peter, you know, taxing unrealized gains seems to be the antithesis of what a government should be doing, of what made this nation great in the first place, and that's encouraging investment.
Well, absolutely. If you look at the wealth of the billionaires in America, it's about $4.5 trillion. And if you look at Joe Biden's ambitions, it's about $5.5 trillion. He simply can't get all the money he wants this way, and this tax is very impractical to apply, but that ground has been covered. What that means is, if he starts applying this kind of tax to billionaires, 2-3 years from now, when they want to make all those programs permanent because they don't have enough money, they're coming after ordinary people. Ordinary people, for example, someone who owns a $500,000 house, and it goes up 20% in a year because that's the way the market is going. All of a sudden, it's worth $600,000. Does that mean the federal government's going to turn around and ask grandma, who's living in the house, for a check for $25,000 or $30,000? She'll have to sell the house to raise the money.
And to your point, they admit that Nancy Pelosi admits, hey, this is going to raise maybe $200 billion. In the grand scheme of things, that's nothing. By virtue of that alone, it's got to go beyond 1,000 people. And once I think those barn doors open, Peter, it's not going to stop. I think that grandma you just talked about would be forced to sell her home. Let's talk about Secretary Yellen, because she says that officials have not lost control of inflation. I mean, what do you think about that statement?
Well, I mean, we know that the Fed and the Treasury are terrible at predicting inflation. When she was chairman of the Fed, she kept saying that inflation would go up, and it didn't. Now they told us last summer it was temporary, and it's not. The reality is inflation is now becoming deeply embedded in the expectations of businesses and consumers out in time. People are now raising prices today, expecting more price increases tomorrow. And folks that work for a living are now thinking about, how do I get a raise, not just now to catch up, if I can, but a raise next year and the following year. Right. We call that a wage price spiral. It's the kind of thing we saw in the 1970s, when the Fed then told us it was temporary, when the Fed then told us it was isolated to certain sectors. You know, it's all new again. I mean, everything old is new again at the Fed. They live in a bubble over there. They've got 400 PhD economists who are telling them inflation is temporary. You know what I think? They ought to hire a bunch of, we have tarot readers here in Washington. You know, those folks aren't getting enough trade because people aren't going to their offices. We ought to round them all up, send them to the Fed. They'll work for $50,000 a year. And the money that we save by putting those economists to work in their best alternative employment, which might be sweeping the streets, working at Starbucks, things like that. I mean, any economist at Treasury or the Fed that tells you inflation isn't a big problem, gee whiz, I'm glad I didn't go to school where they did, and I'm glad I didn't educate any of them.
You know, Peter, I was just thinking maybe we can line up a few of those yellow school buses and take them on a field trip. We go to a gas station, then we go to a supermarket. I mean, you know, maybe that might work. Peter Morici, thank you so much. We'll talk again.
That's a great idea. I love it.
All right. And now I'd like to bring in our market watchers, Gary Kaltbaum and Art Hogan. All right, guys, Janet Yellen saying, don't worry, they haven't lost control of inflation. It's not out of control just yet. Gary, your thoughts?
I think that she has her butler buying her food and her driver buying her gas and filling the tank because she's not living in the real world. She's not stating we're not out of control. She is now praying it is now not out of control. And to be clear and to be as blunt as possible, if it gets out of control, it will be a horror show, especially when you have massive debt and massive deficits and massive leverage at the same time. And may I also state, the culprits are, it started with Bernanke, led to Yellen, and then the championship belt goes to the guy running the joint now with his monstrous, gargantuan, monolithic printing of money along with the lemmings around the globe. They have enabled all this with too much money for too long of a time.
You know, Art, could she even admit it? I mean, it feels to me like she has to understand all of this. I mean, you know, is she just so boxed in that she can't admit it? Maybe there is a fire drill going on somewhere that we don't see?
Well, I will tell you this. If you look at her comments from over the weekend, she did, in fact, say that we're going to have higher inflation longer than we anticipated, well into 2022. I do think that when we go back and say, you know, we've been talking about inflation for the last 20 years and not seeing it, then working our way into and out of a pandemic to see some inflation in the near term likely is a natural offshoot of that. We shut our economy down, we turn it back on. That's not an easy process. So clearly aggregate demand exploded a lot faster than our ability to find aggregate supply. But I think that in a lot of ways, the commodity-based inflation likely calms down as we head into the first half of next year. And we've seen sequential improvement on a month-over-month basis. So if you focus just on those 5% numbers that you see in the CPI on a year-over-year basis and not think about the comparison you're making to a year ago, then I think you're missing the point. Month-over-month, how have we done? And the increases are starting to decelerate.
Well, the baseline, we understand the baseline comparisons to last year, you know, can lead to some exaggeration. But when you ask consumers, you know, like the New York Fed, where do you see inflation a year from now, 3 years from now, 5 years from now? Those numbers are off the chain. And those really do affect regular people who are at their kitchen tables trying to make life decisions day to day. So, it was an unprecedented period. We'll all agree on that. But it just feels like they're getting paid to be a little bit better than that. Let's talk about this market for a moment. I really want to talk about the stock of the day, Gary, because you and I have talked about this before. Tesla just ripping the cover off the ball. I mean, what the heck is going on?
Look, 2 weeks ago on this show, I said Tesla is emerging again. And I made it my biggest position right after that. And surprise, surprise, another game-changing announcement, 100,000 cars to Hertz. You can bet you know what, that others may just follow. So you have a story of there's still a big short position. Earnings are still good. Revenue is still good. I keep hearing they don't make money, but they do. And now this story. And I think we're probably in that melt-up phase that I talked about over the last 6 months. And here we go. I expect the stock to continue higher in the near term. Probably, I don't like giving targets, but I think probably another 20% or so, and away we go.
Morgan Stanley put a $1,200 target on it today, but again, you're going to see $1,200, $1,300, $1,400. You're going to see these targets come out as the street adjusts once again. Art, to that point, we are. Some people are calling this a melt up. I don't dig the term that much, but obviously we're breaking highs, new highs begat new highs. But here's the interesting thing. This is against a backdrop where, according to at least one source, there's a 73% probability of 3 rate hikes next year in 2022. How can those two things coexist?
Yeah, it's such a great question, and that's interesting. So you're looking at the Fed funds futures, and that's exactly what that is. It's people trying to guess when the Fed moves on interest rates before they've even started to taper. And I think that oftentimes, if we look back in history, coming out of the Great Recession and thinking about how good those Fed fund futures were at predicting what the Fed's actually going to do and what they ended up doing, were in most part two different things.
Art, what are you modeling for? I mean, are you investing right now with the assumption that there'll be 3 rate hikes next year?
No, I think there's going to be 1 rate hike next year. I think they get through the taper process in the middle of next year, start talking about rate hikes, and probably get one accomplished in the fourth quarter, and then gradually sort of work their way, away from emergency interest rate levels and Fed funds levels in 23. But yeah, they'll start the ball rolling in 22. I just don't think they get 3 accomplished in 22.
Yeah, that sounds an awful lot, and I don't think the market believes it either. Not with this rally. Hey, Gary, congratulations again. I hope folks watch and take notes. Art, great stuff. Thank you both very much.